the number of decisions to make, and the interconnectedness of those decisions, not to mention the alphabet soup of acronyms to learn, R&D, IRMA, QCD, QLAC. It's almost laughable. Add in factors outside of our control, such as market performance, tax law changes, and modifications to Medicare and Social Security policies, the entire retirement planning process can seem quite overwhelming. The 4 topics we'll cover today. We had started with 5, but we decided we didn't want to bore everyone too long, so we've cut it down to 4. Were selected because they are often top of mind for pre-retirees and covered often in the financial press. They are also 4 topics where we do have some control over what happens, and advanced planning can be especially impactful, both financially and emotionally. And with that, Jenifer will kick off topic 1, asset allocation, and discuss why pre-retirees should consider shifting their investment portfolio to a more conservative allocation. Jenifer?
Thank you, Tammy and Leslie, and thank you to the audience for being here tonight. And while Leslie mentioned it, I did want to remind everybody again that these topics and the positions that we were to take on them were randomly selected and given to us by Leslie. Because as you might see, they kind of make me look all buttoned up and conservative, and Tammy as a bit of a gunslinger. So with that, we'll kick it off with asset allocation. So why should we consider making changes to our asset allocation as we approach retirement? Well, most retirees are dependent on their assets for income to fund their living expenses and lifestyle. So reducing the risk profile of the portfolio may be appropriate so that these assets that a retiree is dependent upon to fund those living expenses is not unduly exposed to market volatility. Secondly, the dependence on these assets might also require that higher income producing assets, such as bonds, comprise a larger portion of that asset allocation pie, and at the expense of our equity exposure, which tends to generate less income, but hopefully more growth. Typically, we will move a client's portfolio towards a more conservative asset allocation over time as the client is moving towards retirement. Now, how quickly or slowly we do this depends upon what the plans of the client are for retirement and how early or late they're making their plans. So are they in a full-time position that they plan to just scale back? Or are they going to leave that position and perhaps do some consulting work or get a part-time job? Or the day they turn 65 and can get their Medicare, they are calling it quits and heading to the beach. So those decisions that a client makes will help us and guide us in terms of how quickly or slowly we're going to move a client's portfolio to a more conservative positioning and more income producing positioning. So now Tammy's going to talk to us about why we might want to maintain a higher risk portfolio even into retirement.
Thanks. So Jenifer's provided some important reasons pre-retirees and retirees should consider shifting to a more conservative investment allocation. However, I'm going to provide 3 reasons why not to automatically shift to a more conservative allocation, and perhaps one of these reasons will resonate with you. First, some retirees and pre-retirees may already be very conservatively invested. Some people invest more cautiously while working, whether due to risk aversion, lack of focus on the portfolio, or to avoid repeating prior investment errors. Shifting to an even more conservative allocation without thinking it through could have a negative impact on the long-term reliance of that retirement plan. Second, taxes. And this is not the first time you'll hear us talk about taxes as we run through these topics. Taxes could take a bite. If someone has a heavy stock allocation or stock fund allocation in a taxable account, especially if they bought those investments long ago at low prices, selling them can trigger significant capital gains, which results in significant capital gains taxes. And those taxes, paying them early in retirement, could impact other areas of retirement planning. And third, retirement's a long game. For most retirees, and what a lot of the research says, is that the goal is to have a portfolio that lasts 30 years, or maybe even a few more, without worrying too much about the ups and downs of the market and the portfolio value. However, some fortunate retirees want to plan and can plan beyond 30 years. Their focus is building a legacy that could last 40, 50, or maybe even 60 years. With that kind of timeline, long-term growth opportunities may be more important and short-term market swings may matter less. So with that in mind, give some thought to your own asset allocation and how you're thinking about it as you consider retirement or if you're already in retirement. Now, let's turn our attention to withdrawing money from investment accounts. For many retirees, after so many years focusing on adding to the accounts and adding to the accounts and adding to the accounts, starting withdrawals can cause some serious anxiety. And I expect to be in that anxiety camp when the time comes, despite all of my education and experience in this area. Jenifer's going to start off the discussion on withdrawal strategies and specifically why the 4% rule is a viable strategy to consider.
Okay, so the 4% rule. We've all heard about this 4% rule, this one and done approach to retirement. Set it and forget it. And wouldn't that be wonderful? So I'm going to talk about how fabulous this retirement strategy can be. And then Tammy's gonna do a little bit of a reality check for us. So what is this 4% rule? The 4% rule came from a study done by William Bengen in the early 90s that showed that over every 30-year period since 1926, if someone started in year one of their retirement withdrawing 4% of their portfolio and then adjusted that amount for inflation each year, that in all 30-year periods, a person would not run out of money after living on their nest egg for 30 years. So, for example, at retirement, a retiree has $1 million portfolio, and they're going to withdraw 4% in year one, so $40,000. And then in year two, they're going to adjust that 40,000 for the rate of inflation that year. So again, over every 30-year period going back to 1926, if you took that approach, in no time periods would you have run out of your nest egg. And this, as an aside, this study assumes a roughly 50-50 asset allocation split between stocks and bonds throughout retirement. So why is this such a popular concept? I think it's because it at least appears to be relatively simple to implement. Tammy might share with us why that might not be the case. And, who doesn't love simple when it comes to retirement planning? It also smooths out withdrawals and gives you a fixed income amount that you can plan around, kind of like a pension. And you also know that that amount is going to be adjusted for inflation. Sounds easy, right? Well, now Tammy's going to rain on our parade a little bit and tell us why we might want to dig a little bit deeper.
Thanks for that introduction, Jenifer. Although my assignment's to provide a counter argument to Jenifer's points, and I look forward to sharing those arguments, I would be remiss in not admitting that I think 4% is as good a place to start as any when thinking about what retirement withdrawals might look like for any particular any particular retiree. So back to my three counterpoints. The first one, the 4% rule, really a 4% guideline, is oversimplified in some respects. Yes, knowing that there is a percentage, and that's the amount to start with, sounds great. But how do you decide which accounts to take it from? Should it come from pre-tax accounts? Should it come from a Roth? Should it come from a taxable account? How do you decide if a portion of that or what portion of that 4% should come from your stock allocation or your bond allocation? And what the heck to do about taxes? How does that fit into that 4% guideline? So yes, simple in some respects, but I think in sometimes oversimplified. Secondly, spending is not fixed. Retirees don't spend the same amount every year, at least not any retirees I know. Expenses fluctuate, sometimes positively and sometimes not so much. A set 4% with inflation adjustments just doesn't provide the necessary flexibility some retirees require and/or desire. And third, market conditions matter. As Jenifer explained, the 4% guideline assumes a steady withdrawal rate regardless of market performance, and William Bangen's research does cover decades of variable investment performance. But in a prolonged downturn, withdrawing the same amount could drain a portfolio too quickly, and that portfolio might not make it to that 30-year period. And in a prolonged period of better than expected returns, withdrawing based on the 4% rule may result in missed opportunities to take another vacation, support a family member or charity, or simply to have a little more fun. So you may be asking yourself by now if there are alternative strategies to the 4% rule. There are many, and instead of relying on a one-size-fits-all rule, retirees might consider others, such as winging it. Just kidding. Definitely not a recommended approach, but it is one that many retirees decide to take. There's a strategy called the dynamic guardrail strategy or methodology. Also, some retirees use the required minimum distribution calculation method. We could spend an entire webinar discussing different strategies for taking portfolio distributions, but we don't want to put you all to sleep. Moving on to our third topic, and another important decision point is Social Security, and I will turn it back to Leslie to kick this one off.
Thanks, Tammy. So just FYI for everybody out there, your withdrawal strategy is not set in stone. And I can speak from experience when I say that it's fluid, and we review our retirement plan, our financial plan every year with the team. And sometimes we make changes, and it depends what happens in our lives. So it's good to have a place to start, and then it's important to understand the fluidity of your plan. So next, Social Security. Wow, this is a big topic and one that is really in the news these days. So let's start with Tammy. What should we know about Social Security and when to take it?
Yep, so big topic, lots of questions just about every time we talk with pre-retirees and retirees, both just the concept of understanding how it works with regard to spouses and children and other situations, and then when to start taking benefits are the big questions. And as many of you are likely familiar, most experts recommend retirees delay collecting benefits until 70. And that's going to be my position on this topic. However, as you might know, and you might be able to see from one of our slides, the most common age to start benefits is actually 62. And in fact, 56% of retirees start retirement benefits by 65. So even though all those people are starting earlier, and maybe they know something you don't, let's talk about a few key reasons why waiting until age 70 might be a great opportunity. First of all, there's that guaranteed 8% annual increase that occurs between somebody's full retirement age and age 70. And that 8% guaranteed increase does not come with any investment risk. That is a guaranteed growth rate that's hard to consistently beat with investments or annuities. Second, longevity, longevity, longevity. Did you know that the longer you live, the more likely you are to keep living? And in my experience, retirees worry more about outliving their money than leaving some behind. A higher guaranteed monthly income over a potentially longer period of time provides greater peace of mind. Which leads us to the break-even analysis. Maybe you've heard of that. That is often depicted as a method to evaluate when to start benefits. It's the point at which claiming Social Security benefits early and collecting for more years generates about the same total lifetime payout as starting benefits later and collecting for less years, assuming Social Security's average life expectancy forecasts. While the analysis can be a good starting point, who wants to make such an important decision based on average life expectancy if the goal is to live a long, healthy, and productive life? Third, delaying Social Security benefits to age 70 could protect your spouse. If the higher earning spouse delays benefits until age 70 and is collecting the maximum amount, if that spouse dies first, the surviving lower income earning spouse will continue to receive that larger amount. It's kind of like creating one of those old-fashioned pensions some of us might know about that benefits both spouses for the longer of the two lives. Now, let's see if Jenifer can sway your thinking to consider starting benefits before age 70.
Okay, well, Tammy just shared with us all the great reasons why we should hold off on taking Social Security until age 70. And in a perfect world, that is the optimal choice. But of course, it is not always a clear and cut perfect world. And sometimes the answer might be something different. So I'm going to talk about why we might want to, why someone might want to consider taking Social Security at full retirement age. And, quite simply, there are people who just need the cash flow and just can't wait until age 70 to begin collecting. They have either chosen to retire or been forced into retirement due to a job reduction, or perhaps they have health issues and just can't work anymore and don't have other means to support themselves. And then there are situations where if a retiree delays benefits and lives off of their investments while waiting for age 70 to begin taking their Social Security, this approach could do more harm than good to their overall nest egg and financial situation long term. If depleting too much of their nest egg leaves a retiree with little liquidity, and if they should have some large unexpected expenses later on, then it might make more financial sense to take Social Security early and forego the 8% annual increase that Tammy talked about. There are some situations where perhaps someone has a very elderly parent or other relative who, upon their passing, will provide a significant inheritance at some point down the road. Of course, we don't necessarily know when, but in these cases, the retiree can afford to live with a smaller monthly income throughout their retirement, knowing that there will be additional assets coming their way later on. And then there are the situations where a retiree has significant health issues and they really don't expect to live well into their 80s. As Tammy discussed, the concept of the break even of waiting until 70 versus beginning at full retirement age. So the break even is somewhere in the early 80s. So if somebody doesn't expect that they are going to be living well into their 80s, it would likely make more financial sense to begin taking Social Security at full retirement age. So we've talked about, three levers of income planning for retirement. Now we're going to shift gears a little bit and talk about our balance sheet. Tammy's going to talk about why we might want to hold on to our debt even in retirement. So, Tammy?
Yep. So again, we were assigned these positions randomly. And so I have to start by saying that in principle, I agree that most debt, especially high interest debt, should be paid off before retirement. In fact, I recommend eliminating and frankly avoiding that kind of debt at any age when possible. But not all debt is bad debt. And for this topic, let's assume we are talking about a low interest rate debt such as a mortgage. Here's why a retiree should consider holding on to that debt. First, low interest debt can work in a retiree's favor. If the mortgage rate is significantly lower than what a similarly structured safe investment, such as a bond or CD or maybe a fixed annuity, is paying, keeping the mortgage could be a smart financial move, kind of like a form of financial arbitrage. As an example, one retiree I know has a fixed 2.4% long-term mortgage and has locked in fixed annuities for their savings paying 4 to 5.8%. Secondly, paying off debt can trigger a big tax bill. Remember when we were talking about asset allocation and I mentioned that taxes would come up again? Well, here it is. If paying off the low interest debt requires selling investments with significant gains in a taxable account or taking a significant distribution from a pre-tax retirement account, a large tax bill early in retirement could definitely derail future planning and is one reason why, depending upon the size of that debt and where it fits, some advanced planning is definitely necessary. And third, plans for the home matter. If a retiree is considering moving in the next few years, tying up more money in an illiquid asset by paying off that mortgage with the intent of selling it later may not be the best use of anyone's capital. I'll turn it back to Jenifer now to convince us why paying off debt, even low interest rate debt, before retirement is a good move.
Yeah, so for many people approaching retirement, paying off their mortgage is just a goal that they have set for themselves since that they made that first mortgage payment. People tend to like the idea of being debt-free, especially in retirement. So that's just the emotional piece. It feels good to be debt-free. But what about the financial piece? For most, retirement generally means living on a fixed income. There are no more bonuses or promotions or new jobs or other means of bumping up your income so that you can spend more. So when you're living on a fixed income, reducing non-discretionary expenses, and a mortgage payment would certainly be considered a non-discretionary expense. It generally means you have more flexibility with spending on discretionary expenses or things that you enjoy doing, such as hobbies or travel. We all enjoy having more spending money to have fun with, and paying off your mortgage before your retirement affords you with this kind of flexibility. So this concludes our prepared discussion. We are now going to open it up for Q&A. So if you could please submit your questions and Leslie will go through them for us. Before we jump into that, I would like to thank everyone again for your time tonight. We did decide to do this webinar because there are so many decisions to make at this stage of life. It can be really overwhelming. And we've touched on just a few tonight. As Tammy mentioned, we kept it a little bit shorter because there's a lot of information, and we didn't want to overwhelm or bore you more than necessary. But as you can gather,